Welcome to the deep dive. We're jumping straight into a corporate call that has caused some serious market confusion.
Right.
We're talking UniFirst Corporation, ticker UNF, and their Q4 fiscal year 2025 results.
This was a real case study in dissonance, wasn't it? You had a genuinely solid operational quarter. I mean, a beat on both the top and bottom line.
Great execution.
Exactly. But all that positive momentum was just, completely annihilated by the forward-looking guidance.
Absolutely. We saw the stock crater to a fresh 52-week low pre-market. It's that classic investor dilemma. Do you trust the stability you see today, or do you panic over the costs that management is telling you are definitely coming tomorrow?
And that's our mission today. We need to quickly unpack that blowback for you. We have to understand why management felt they had to issue guidance that was so brutally below consensus.
And how they justify it.
Yeah, how they justify this massive strategic reset. It all comes down to accepting this near-term pain, this profitability compression for, hopefully, future scale and margin expansion.
Okay, so let's ground ourselves in those Q4 results first, because, like you said, they were good. GAAP earnings per share landed at $2.23, which was about $2.28 adjusted. That sailed past the street consensus of roughly $2.15, so 13-cent beat.
And the revenue followed suit, came in slightly ahead at $614.4 million, meeting the $607 million expectation.
And if you normalize for that extra week they had in the prior fiscal year,
the year-over-year growth was still a healthy 3.4%.
Yeah.
That shows steady, resilient, organic growth in their core business.
Right. And beyond the P&L, the balance sheet looks, well, really stable. Adjusted EBITDA margin held firm at 14.3%. But the real fortress is the cash position.
Oh, absolutely. Over $209 million in cash and short-term investments. And this is the crucial part zero long-term debt on the books.
Zero.
That kind of financial strength is usually the anchor for a defensive stock like UNF. But the market just ignored it. Ignored the cash, ignored the beat. Why?
Because it was all about the forward-looking statements.
100%. It tells you every single investor was focused on one thing, visibility into FY26 and when, or maybe if, that earnings power comes back.
So here is the core problem that caused that plunge. The divergence between management's FY26 outlook and what analysts expected was, frankly, shocking. Management guided full-year EPS between $6.58 and $6.98.
And if you look at the FactSet and LSEG consensus data, the street was expecting something like $8.60, $8.70.
Wow.
You're looking at a full-year profit outlook that is lower by more than 20% at the midpoint. This wasn't a small adjustment. This was a fundamental reset.
Yeah, that degree of revision signals something major is happening inside the company. Management laid out 4 primary reasons. Let's start with the one that gets the most attention, the ERP system rollout.
That's the big lever. The company is now deep in the core phase of their transformation. This Oracle ERP deployment and CRM modernization. They call them their key initiatives. And management basically confirmed these costs are reaching their absolute peak in FY26.
And this creates a lot of complexity for investors because these costs, they hit the earnings in different ways, don't they?
Precisely. You have to separate the cash impact from the non-cash accounting noise. First, they cited $7 million in costs directly attributable to these initiatives. That's cash out the door.
Okay.
But the larger headwind comes from non-cash charges. As they go live with the core financial modules, they have to start amortizing the capitalized costs. This elevates 2 things dramatically: D&A depreciation and amortization, and SBC, or share-based comp.
So wait, if I understand this correctly, the D&A and SBC charges are what's really hitting that GAAP earnings number, that 658, but they don't actually impact the company's immediate cash flow.
Exactly right. It's an accounting drag that's masking the underlying operational performance. They even specifically called out $4 million in additional amortization hitting the guidance just from the system deployment alone. It's a heavy, temporary, non-cash burden.
That sounds like necessary pain for future gain, but history is littered with corporate ERP rollouts that turn into multi-year operational drags. Management is asking for a lot of trust here.
That is the ultimate question for long-term holders. Management's view is that this Oracle system is essential to unlocking next-gen route optimization, pricing, all of that. But you're right, the execution risk is very real, and it's why the market is punishing them today.
Okay, let's move to the second pressure point, which is also about investment. Strategic growth spending.
Yeah, and this is a deliberate margin headwind. The company is intentionally investing ahead of revenue growth. They're strengthening service teams, adding headcount and sales. In short, they're paying for the expansion now before the revenue fully shows up.
So they're basically saying, we'll accept lower margins in 26 because we're betting this investment accelerates our core growth from, the high 2% range toward mid-single digits later on.
Precisely. It's a deferred gratification strategy. Now, the third headwind is external, something they can't control at all: tariffs.
What does that unexpected tax bill look like on their P&L?
Well, the influence of these new tariffs is expected to impact profitability, but not all at once. Management noted it'll be more pronounced in the back half of FY26 as higher cost goods move through their inventory.
So it's a slow burn.
It's an inflationary pressure that they can't just immediately offset with price hikes. And then there's the fourth factor, which is cyclical but really painful for earnings: the step back in nuclear services.
This creates a really negative mix shift, right?
Mm-hmm. Their other segment is mostly nuclear services. It's high margin, but also high fixed cost. And they are forecasting a severe revenue drop here, down 16.3% in FY26.
Why such a dramatic drop?
It's a double whammy. You have the wind down of a large reactor project and just a cyclically lower number of nuclear plant outages scheduled for 2026. Because that business has fixed costs, when the revenue drops that much, it has a huge negative impact on profitability.
So, okay, that makes the guide down totally understandable, even if it is painful. You've got the ERP surgery, prepaid growth costs, the tariff tax bill, and a cyclical trough in a high-margin unit, all hitting in the same year.
That perfect storm is exactly why the stock reacted so violently. But if we want to evaluate the long-term thesis, we have to look past the accounting noise. We have to focus on the core health that's supposed to justify all this.
And to help investors do that, management announced they're now reporting results across 3 distinct segments: Uniform and Facility, First Aid and Safety, and Other. That increased visibility is a welcome change.
Absolutely. Now we can really see how the core Uniform and Facility segment is doing. Organic growth in Q4 was 2.9%. It's stable, but management is clearly not satisfied.
They mentioned a softness in the employment environment, which, fewer wearer numbers. So how are they planning to fight that macro pressure?
They're focusing on sales efficiency. They're moving to a tiered selling model, which just means they're being more strategic about deploying their best salespeople to the highest value prospects.
But the real growth story, the segment that sort of provides the counter-argument to all the guidance noise, is First Aid and Safety.
This segment is a rock star. It saw genuinely strong organic growth of 12.4% in Q4.
12.4.
Yeah, driven by what they call the van business direct service routes.
That's 4 times the growth rate of their core uniform segment. What's making it outperform so much?
It's all about route density and market penetration. As they add first aid customers, they're leveraging the same physical routes as their uniform trucks. The incremental cost is low, and they see a long runway for growth. They're even guiding for double-digit expansion again in 26, around 10%.
So this is the proof point for the future growth thesis.
It absolutely is.
Okay, beyond revenue, what about efficiency? They mentioned the UniFirst way and their investment in digital infrastructure to claw back some of these margins.
Right. The UniFirst way is their standard operating procedure. But the tangible investment they highlighted is telematics. They're rolling out inward and outward-facing cameras across their entire fleet.
That sounds like a major expense today. What's the payoff on that?
It's a long-term play, mostly for FY27 and beyond. The goals are better driver safety, which means lower insurance costs and better fuel efficiency. It just underscores the theme of the call: spend money today for higher profits down the road.
So if we synthesize this for the listener, the long-term narrative is that FY26 is a necessary temporary step back in profitability. The payoff is supposed to be higher margins and faster growth in the future.
That's the management pitch, but it fundamentally shifts the investment thesis. UNF used to be a classic defensive compounding stock, boring, reliable. Now it's a prove-it stock. Investors are just waiting for confirmation of that $8 plus earnings power post-ERP.
So if you're watching this stock, what are the, say, 3 non-negotiable watch items you need to track every quarter?
First, you have to track the ERP. When does that heavy D&A and SBC expense normalize? Second, you need to see that core uniform growth sustain 2 to 3% and then start accelerating. And third, listen for any color on the margin rebuild for FY27. They need to provide visibility on that.
And now, It is time for our segment where we pitch an outrageous but plausible trade idea based purely on what we just covered. And remember, everyone, this is for discussion and entertainment. This is not financial advice.
Okay, the trade idea is long UniFirst with a focus on an FY27 recovery.
All right, this is the moment for skepticism. You're suggesting buying a stock that just guided down 20% and hit a 52-week low? Why are you bullish when everyone else is running away?
Because the market is confusing accounting noise for operational failure. The thesis is that UNF is fundamentally mispriced because that huge EPS guide down is dominated by non-cash transient stuff, the DNA from the ERP, the high SBC, and that cyclical trough in the nuclear segment.
So you're saying if we look past the accounting book earnings, the story is entirely different.
Entirely. The operational core is healthy and performing. If you strip out the non-cash ERP noise, the core cash earnings profile doesn't look nearly as bad as the headline JAP number suggests.
Okay, but what about the risk that this isn't temporary, that it becomes a multi-year drag?
That's where the balance sheet comes in. With $209 million in cash and zero debt and their commitment to buybacks, they spent $70 million in FY25. This stock is, well, it's a self-funding, deeply discounted call option on Oracle optimization.
A self-funding call option on Oracle optimization. That's a powerful frame.
They have the firepower to survive a delay. Current skepticism is the entry point for anyone willing to look past the accounting fog of FY26.
So the catalyst is purely a matter of time and execution.
It is. The stock re-rates sharply in 2027 once that DNA and SBC headwind normalizes and the market sees that $8 plus EPS power return. The market today is pricing for permanent damage while management is predicting temporary investment.
That brings us right back to the core tension of this deep dive. A solid operational quarter undone by conservative guidance tied to strategic investments and cyclical headwinds.
Management is banking on the long-term enabler theory of ERP. So the provocative question for you to think about this week is this. Of those four profit headwinds, the ERP peak, the sales investment, tariffs, or the nuclear trough, which one will normalize the quickest? The answer to that will dictate the pace of the stock's eventual recovery.
That's a great frame for ongoing research. Thank you for joining us on this deep dive into UniFirst's very complex quarter. We look forward to hearing your thoughts, and we'll catch you on the next deep dive.